Hello friends, how are you? I hope all of you are doing really good. So welcome to another session of Financial Management Revision for CA Intermediate November 2023 exams. And the chapter that we are going to do in this lecture is Receivables Management, or this is also known as Debtors Management, the receivables or the debtors management. Now, a very simple question, sir. When will the debtors be there in your books? The debtors will be there only and only when you are doing the credit sales, isn't it? The debtors will be there only and only when you are doing the credit sales. Now, why is it necessary to manage debtors? Sir, because we have to collect money from the debtors, right? Credit sale is what? The credit sale is very simple, sir. Credit sale is buy now, pay later. And if you imagine yourself going to a shop and the shopkeeper says that, sir, you take the goods worth 10,000, pay after 1 month, after 2 months, you will be very happy, isn't it? You will go to that shopkeeper again and again. So the business has to resort to credit sale for the business purposes. Now, very simple thing. Sir, if you talk about the sales can be done in two ways, right? The sales can be done in two ways. Either it can be a cash sale or it can be a credit sale. Every businessman, he is always interested in the cash sale. Why, sir? Because he wants that he should convert the goods into cash quickly. But he has to resort to the credit sale. Why, sir? What will happen if he is selling on the cash, and what will happen if he is selling on the credit? Sir, cash sale means lower sales. The sales will be comparatively on the lower side, lower profitability because the sales are lower, sir, lower profitability. Because obviously you will go to a person who is ready to give you goods on the credit rather than the person who says cash first, after that goods, right? You will go to the person, you will go more to the person who is ready to, who is willing to give you goods on the credit, right? That is why in case of cash sale, the number of customers will be less, the sales will be less, the profitability will be lower, but there is high liquidity. You will have high liquidity, sir, right? Because you have more and more cash in hand. On the other hand, if you go for the credit sales, what will happen, sir? Higher sales, right? Higher sales, and you will be able to retain the existing customers because the customers will be happy, sir. Retain existing customers, right? Because the customers will be happy. I told you that if a shopkeeper is willing to give you goods on the credit, you will go to that shopkeeper again and again. So you will become the loyal customer of that shopkeeper, right? And that shopkeeper will be able to attract new customers, right? This shopkeeper, because of higher sales, will have high profitability. Yes, sir. He will have high profitability. But at the same time, in case of credit sales, you will have low liquidity. So what debtors management is trying to teach us? The debtors management is trying to teach us how to create a balance, how to create a balance between liquidity and profitability. Sir, the liquidity is also important for the business to meet the day-to-day expenses. How to create a balance between profitability and liquidity, right? So this is what the debtors management is all about, that how to create a balance between profitability and the liquidity. This is very important. That is why we are studying this chapter of debtors management, right? So in this scenario only, what we are trying to identify, to whom the credit should be allowed, whether it should be allowed to customer A or whether it should be allowed to customer B, based on the analysis. Based on what? This decision you will take on the basis of, based on past analysis, right? That what is the track record of the customer, whether the customer pays on time or whether the customer does not pay on time. Accordingly, you will decide whether the credit should be given to that customer or not. The second point to look here is that how much of the credit period should be allowed, right? Whether the person should be given the credit for 30 days, for 40 days, for 60 days, what should be the period that should be allowed? Third thing is how much of the amount of credit should be allowed, right? If the customer is a good friend and you know that you are going to 100% sure you are going to get recovery from that customer, then you can give more credit. If he is purchasing the goods for 1 crore rupees, so you can give the credit for, let's say, 90 lakhs, 80 lakhs, 70 lakhs. But if you are doubting the payment of that customer, then you have to give less amount on the credit. You will say 50% you will have to pay in the cash and 50% I'll give you on the credit. So these are the things that in any business we have to decide, sir. Right? Tomorrow you might also be doing, any one of you from amongst you must also be doing the business, right? And these things you will have to face, right? So imagine yourself in the real situation. Clear? Okay, after that, what is there, sir? The credit period. What is the credit period? Credit period is the period for which the payment is not required to be done. For example, 30 days, 60 days. You say, take the goods today, pay me after 30 days, pay me after 60 days, right? So those 30 days, 60 days is the credit period that you are allowing to your customer. Net 60. The credit period is given to you as net 60. The customers are required to pay within 60 days. Right? And sir, what will happen if it exceeds 60 days? Then you might charge on the you might charge interest on the amount, right? Or you might initiate some legal proceedings against that person if he is not paying within the stipulated time, right? Or another way the credit period is given to you is 2 by 20 net 60. What is the meaning of this 2 by 20 net 60? It means 2% discount if the payment is made within 20 days, right? If the payment is made within 20 days, we'll give you 2% discount. Otherwise, if you don't want discount of 2%, you can pay within 60 days. Now, why this kind of a policy is there, sir? So that to give customers the incentive of 2% discount, so they pay earlier. Instead of paying in 60 days, they pay you in 20 days, because the customer who is buying from you, he will be interested in paying at the last day. Obviously, sir, when I have to make the payment, if I know that I have to make a payment, I'll pay on the 60th day or the 59th day or 58th day, right? I will want to delay the payment as much as possible. But as a businessman, you want to recover the payment as early as possible. So what you are doing is you are giving an incentive to the customer. Sir, pay within 20 days, take 2% discount. Cash discount. This is your cash discount. Right? So this is how the credit period might be given in the question. After that, another important term is the average collection period. Now, average collection period can be calculated in 3 different ways. The one way is 12 months or 365 days divided by debtors turnover ratio. Now, what does it mean, sir? For this thing, the first thing that you should know is what is a debtors turnover ratio, right? If we talk about the debtors turnover ratio, what is this, sir? Debtors turnover ratio. Sir, this ratio tells us that how many times in a particular period, but I'm right, how many times you are converting your debtors into your collection, how many times you are collecting your debtors. For example, in a particular period, let's say in this period, you are having a total debtors of total credit sales of 8 lakh rupees, right? And on an average, you have debtors of 2 lakh rupees. That means 2 lakh rupees, you are collecting the money, then again 2 lakh rupees, you are collecting the money. On an average, the debtors are 2 lakh. How many times in a year you will convert this 2 lakh into the collection so that you collect a total of 8 lakhs in a year? What I'm saying, listen to it very carefully again. You will be able to interpret it in one way. I'm saying, how many times in a year you will be collecting, you will be converting these average debtors of 2 lakh. How many times you will be converting the average debtors of 2 lakhs into cash, into collection, so that the total collection in a year is 8 lakh. So this is what is debtors turnover ratio. That will be total credit sales divided by what? Average debtors, right? So that will come to 8 lakh divided by 2 lakh. That is 4 times in a year you convert 2 lakhs into cash. That is only then you will be able to collect 8 lakh rupees in a year, right? So what is the average collection period? If in a year, if in the whole year you are collecting it 1, 2, 3, 4, right? You are collecting it 4 times. So after how many days you are collecting it, right? So that is given by 12 months divided by 4. That is after every 3 months you are collecting your debtors of 2 lakh, right? 4 times in a year. That means after every 3 months you are collecting 2 lakh rupees. 3 months 2 lakh rupees, 3 months 2 lakh rupees, right? Or if it is in days, then you can take it as 360 or 365 days divided by 4. That will come to 90 days, right? This becomes your average collection period, that on an average you collect your debtors after 3 months or 90 days. This is one way of calculating. Another way of calculating, sir. What is the another way of calculating? Another way is average debtors divided by average net credit sales per day or per month, right? What does it mean, sir? For example, let's say your average debtors. What is your average debtors? I say your average debtors is 1 lakh rupees. On an average, the debtors in your books are 1 lakh rupees, and your credit sale per day is 10,000 rupees, right? So what will be the collection period, sir? What will be the collection period? 10,000, 10,000, 10,000 on an average 1 lakh. After 10 days, when you have accumulated 1 lakh rupees, you collect 1 lakh. Again 10,000, 10,000, 10,000, 10,000. Well, on an average, you have 1 lakh rupees, sir. Right? Per day it is 10,000. So what is the collection period of those 10,000 rupees? How many times this 10,000? In how many days you will be able to recover this 10,000? So that you have on an average, the debtors are there as 1 lakh rupees. Debtors are 1 lakh. Per day sale is 10,000. So how many days a sale it is? Right? 10 days. So it is the average debtors, that is 1 lakh, divided by average net credit sales, that is 10,000. That will come to 10 days. This is the average collection period. This is how the average collection period we can calculate dependent upon average debtors. On an average, you have the debtors of 1 lakh, that is equivalent to the 10 days credit sale, right? That means after every 10 days you are collecting. On an average, after every 10 days you are collecting 1 lakh, then 10 days 1 lakh, then 10 days 1 lakh. So on an average, the debtors remain at 1 lakh, and per day it is 10,000 rupees. Clear? This is the average collection period in the second way. Now, third way of calculating the average collection period is, let's say if it is given to you in the question this way, 2 by 10. 1 second. If it is given to you in the question as 2 by 10 net 30, right? And you say 30% of the customers pay within 10 days and avail 2% discount, and 70% of the customers pay within 30 days. Now you have two different average collection period. You have two different collection periods. One for these 30% customers, which is 10 days, and another for 70% customers, which is 30 days. So you have to calculate the average period of these two customers. That is the credit period with the cash discount, that is 10 days, multiplied by the percentage of customers availing this, that is 30%, right? Plus, what is the credit period without cash discount, that is 30 days, multiplied by 70%. So this will give you the average collection period, whether it is 30%, whether it is 70%. You need one collection period, that on an average, what is my collection period? This will be defined. So in these three ways, you can identify your average collection period, right? So in these three ways, you can calculate the average collection period. If debtors turnover ratio, you Might get a question in which the debtors turnover ratio is given to you. So average collection period, this is how you can calculate. In some of the question, average debtors will be there, net credit sales per day or per month will be there. So you can calculate this way. If the cash discount is there, you can calculate average collection period in this way, right? Okay, now coming to the next topic, that is opportunity cost of investment in receivables. Now, what is this opportunity cost of investment in receivables? Listen to it very, very carefully, right? Okay, I'll write here now. The topic is opportunity cost. Very important topic, sir. Opportunity cost of investment in receivables. Right now, what is happening, sir? I say there is a product A, there is a particular product A that we are manufacturing, and we have manufactured 100 units of it, right? On these 100 units, there will be the cost incurred. I'll call it as total cost, right? Now, why I am writing it as total cost, sir? Because this cost can be bifurcated into variable cost and fixed cost, right, sir? Absolutely correct, right? Now, the total cost incurred on this is, let's say, let's say it is rupees 10 lakh, right? Now, what happens, sir? The next I say that sold 100 units to Mr. X for rupees 12 lakh on a credit of 30 days. Now what will happen, sir? Mr. X will take the goods, go back to his factory, right? But he is going to pay you after 30 days. Within 30 days or at 30 days, he is going to make the payment. So my simple question is, when are you going to recover this amount? What is the amount that you have invested in the making of that product from your pocket? Is it 12 lakh or 10 lakh? Sir, the amount that is invested from our pocket is not 12 lakh rupees. It is 10 lakh rupees. So, sir, what is 12 lakh? 12 lakh is the selling price, which includes the profit also. So, what is the amount invested? That is 10 lakh rupees, right? This is what? This is the amount invested, right? Now, when are you going to recover this amount? When are you going to recover this amount? This amount will be recovered after 30 days on receipt of money. On receipt of money from Mr. X. Obviously, sir, right? So this amount you are going to recover after 30 days when Mr. X is going to pay you. So I can write this as, what I can write it as, I can write this value as 10 lakh rupees, 10 lakh is invested in debtors. Rupees 10 lakh is invested in debtors for 30 days. Now, what is the implication of that? The implication is that, sir, if you would have done cash sale, if the cash sale is there, you would have received this 10 lakh rupees immediately, deposit in the bank, and you could have earned interest on that. Now, for those 30 days, this 10 lakh rupees you are not going to receive, right? What you are losing is, you are losing, let's say the interest on this 10 lakh rupees is 10%. Sir, you are losing 10% interest on 10 lakh rupees for this 30 days, right? This is what? This is your opportunity cost. This is what? Opportunity cost. So opportunity cost says whatever the amount you have invested in the making of the product, right? And considering the credit period for 30 days, you are not going to recover that amount, right? For 30 days, you will lose the interest at the rate of 10%. That will be your opportunity cost. अगर आपने कैश सेल की होती, if you would have done the cash sale, this you would have received 10 lakh immediately, deposit in the bank, earn 10% interest for 30 days. But now you are not going to earn that because you will receive the money itself after 30 days. You are losing out on the interest for 30 days. So from here we can say what is the opportunity cost. So from here the opportunity cost is the cost of credit sales. Very important, sir. Which cost is to be considered? Only the cost of credit sale. Whenever we are talking about the debtors, you have to focus only and only on what? Only and only on the part of credit sales. That's it. Right? So, what is the cost of credit sale? This is the amount invested. This is the amount invested in the making of product. Clear? Multiplied by collection period. Now here the amount invested was 10 lakh rupees. Multiplied by what is the collection period? Collection period, average collection period, that is 30 days. 30 divided by 365. Right? This 10 lakh is what? This 10 lakh is the cost, total cost. This 10 lakh is the total cost. I want to know what is the investment for 30 days. Right? I want to know what is the money that I am losing in the 30 days multiplied by the required rate of return, that is 10% in our example. Right? So when I write it like this, 10 lakh multiplied by 30 divided by 365 multiplied by 10%. So what does it represent, sir? What does it represent? This part represents investment in receivables. What is the amount invested in receivables for 30 days? Investment in receivables. That what is the amount that is invested for 30 days? Because I will be losing out on the amount for 30 days only. After 30 days, I will receive the amount, I will deposit in the bank and tata bye bye, enjoy. Right? And what I am losing is 10%. So this becomes your opportunity cost. This becomes your opportunity cost. Right? Now, one thing you might have seen in some of the books, or if you have studied from somewhere else, instead of this cost of credit sales, some of the books you will see there they have taken the credit sales is the full amount of credit sales. Right? So even if you take the credit sales here in the calculation, that will also be correct. Right? The institute also allows it. The books, in many of the books you will see this is done. Instead of the cost of credit sales, if you take the total amount of credit sale, that means here instead of 10 lakh, if you take this 12 lakh rupees in the calculation of opportunity cost, because the logic here is that, sir, you have to receive 12 lakh. Whatever you are losing the interest on, it is on 12 lakh rupees. So you can take 12 lakh also, you can take 10 lakh also. Both are absolutely correct. Right? Both are absolutely correct, sir. No issues. Okay. Two important points when you are calculating the cost of credit sale, or when you are calculating the opportunity cost, I would say. Right? Write down two very important points here. Note one. 1 second. Note 1. Bad debts will not be considered. Bad debts will not be considered. Bad debts will not be considered as a part of cost of credit sales. For calculation of opportunity cost. For calculation of opportunity cost, right? So when you are calculating the opportunity cost, there when we have to calculate the cost of credit sales, the bad debts will not be included. Why, sir? The bad debts is out of this credit sales only. The cost is already included in that. We are already considering what is the cost incurred in the making of that. The bad debts will only impact your profitability, right? The bad debts bad debts will only impact your profitability, will only impact your profitability, right? So while calculating the opportunity cost, you have to be careful with this thing. The bad debts are not to be considered. The same treatment is for note 2, the cash discount. If there is any cash discount given in the question, not to be considered for opportunity cost, not to be considered for calculation of opportunity cost, and the cash discount will only impact your profitability, will only impact what? It is going to impact only your profitability. It is not going to impact your opportunity cost. Clear? So these 2 points are important regarding the opportunity cost, that for this purpose what you have to take it, and I have clarified that in the opportunity cost you can either take the cost of credit sales or you can take the full value of the credit sales. Both ways it is going to be correct. In the exam you can take it anyways, right? Preferable, sir, if we talk about what should be the preference, whether preference should be given to credit sales or the cost of credit sales, then I would say the preference should be given to the cost of credit sales, right? This is the preference, because actually what is the amount invested? The amount invested is the cost and not the total sales, right? That is why I would say it has to be cost of credit sales for what is the period, investment in the receivables, and how to calculate the opportunity cost. Everything I have explained to you people, right? The next is evaluation of investment in receivables, or what we call it as evaluation of different credit policies. Let's do this. This is a very important topic. This is the most important topic from where the maximum questions on the debtors management is asked, right? That is evaluation of investment in receivables. Evaluation of investment in receivables, right? Or evaluation of the same topic, we can call it as evaluation of different credit policies. Evaluation of different credit policies. Now, what does it mean, sir? What does it mean? Evaluation of different credit policy. Sir, currently you are following a particular policy. Let's say under that policy, you are giving a credit period. So in this, the whole game is around the credit period. Let's say under the current policy, you are giving to your customer the credit period of 30 days. Now you say, I want to increase this credit period to 45 days. Right? Or you say, I want to increase this period to 60 days, sir. Not 45 days, I want to increase it to 60 days. Now, what will be the impact, sir? If you are increasing the credit period for a customer, will your customer be happy or will your customer be sad? Sir, obviously, if you are going to increase your credit period, your customer is going to be super happy. Your customer will come to you again and again. You were going to a shop, you purchased 10,000 worth of rupee goods, right? The shopkeeper says, sir, take the goods, pay me after 30 days. Next time he says, pay me after 60 days. You will be super happy, right? You don't have to spend the money for 60 days, sir. Isn't it? The same thing is going to happen in the business. So what will be the impact here? Let's try to understand what is going to be the impact here. Impact here will be multifold. Increase in sales. Increase in sales. Right? If your sales are going to increase, obviously your variable cost will also increase. Yes, sir. Increase in variable cost. Right? After that, will there be increase in the fixed cost also, sir? The rent of the building, will there be increase in that? No, sir. No change in fixed cost. No change in fixed cost, right? No change in fixed cost. After that, sir, the more the time, the more the credit period you keep on increasing, the chances of the bad debts will also increase. Increase in increase in probable bad debts, right? The chances that the customer might not pay you if you are giving more and more credit period just to attract the customers. The customer will come, take the goods, but it is quite a possibility that after 60 days, he just runs away with your goods, right? He is not going to pay you. So the chances of bad debts will also increase and more funds will be blocked. More funds will be blocked in debtors. That means what will happen, sir? Your opportunity cost will increase, right? Increase in opportunity cost. Earlier, you will be losing the interest for 30 days. If you increase it to 45 days, now you will, what will happen, sir? Now you will lose the interest for 45 days or 60 days as the case may be, right? Obviously, your opportunity cost will increase. Now, I told you there has to be a balance between profitability and liquidity. That is what we are going to try to analyze through the various credit policies. What are the two things, sir? I told you that there has to be a balance between profitability and liquidity. Profitability and liquidity. Sir, liquidity is represented by our opportunity cost, right? As you keep on reducing your liquidity, that means you are increasing the credit period, you are reducing your liquidity, your opportunity cost will go up. What about the profitability, sir? How do we calculate profitability? The profitability will be credit sales. How will you calculate profitability? Credit sales minus variable cost, right? After that, minus fixed cost will be there. Yes, sir. The fixed cost will be there, sir. Minus bad debts will be there. Yes, sir. The bad debts will be there, sir. No doubt in that. After that, what will happen, sir? If there is a cash discount, yes, sir. As I told you that both bad debts and cash discount, both of these are going to impact your profitability. It is not going to impact your liquidity, but it is going to directly impact your profitability, right? So here, profit minus, you will pay the taxes. If given in the question, you have to take net profit, right? So there has to be a balance between what? The profitability and opportunity cost. The company, what the company is trying to do is, here the company is trying to find out what is the net benefit to the company. What is the net benefit to the company? What does it mean by net benefit? That if they increase the credit period, obviously their profit will increase, but at the same time the opportunity cost will also increase, right? So what is the net benefit that they are gaining? Net benefit is net profit minus opportunity cost. Net profit minus opportunity cost. So what we will do is, we will calculate the net benefit if we are giving a credit of 30 days. We will calculate the net benefit if we are giving the credit of 45 days. We will calculate the net benefit if we are giving a credit of 60 days. In whatever the policy, this net benefit is the highest, we will select that policy, right? So very simple, sir. Credit policy with highest net benefit will be selected. With highest net benefit will be selected, right? So that means under the various policies, you will have to calculate what is the net profit, you will have to calculate what is the opportunity cost, and then you have to analyze what is the net benefit. The policy with the highest net benefit, you will go for that. Now, for the calculation of this net benefit, for the evaluation of this credit policies, we have two approaches. One is known as the total approach. One is known as the total approach, and another one is known as incremental approach. One is known as incremental approach, right? One is total approach, another one is incremental approach. Now I will take up an example, right? And the same question can be done by both the approaches. The same question can be done by total approach, the same question can be done by incremental approach. Now in the examination, which approach is to be followed? If the question is silent, then you can follow any of the approaches. But if the question specifically mentions that you have to solve the question by total approach or by incremental approach, then please, then do not मन मर्जी मत करना यार तुम, ठीक है ना, सिंपल सी बात है सर. Then you have to follow what the question says, right? So let's take up an example here, sir, and try to solve it by both the methods. What is our example? One second. Let's do it. Example, right? Present policy, and we have the proposed policy. Right? Under this, credit sales, 12 lakh rupees, and under the proposed policy it is increasing to 14,50,000 rupees, right? Total cost of credit sale. Now in the examination, it is quite a possibility that you are given the variable cost separately and you are given the fixed cost separately, right? So you have to write it separately. I am taking it together here, but in the question you may be given the variable cost separately and fixed cost separately. That is totally fine, sir. 10 lakh, it is increasing to 12 lakh. Sir, there will only be an increase in the variable cost. The fixed cost will remain same, right? After that, the bad debts, 1% of the sales and 2% of the sales, right? Then we have the average collection period or the credit days. That is 45 and here 60 days. After that, required rate of return. Required rate of return is 10%. Now he says evaluate the policy using the total approach as well as using the incremental approach. You have to evaluate it by both the methods. Okay, let's do it by total approach first. So first we'll do it by total approach. The first thing that you have to calculate is the profitability under the different policies, right? So we have the present policy and the proposed policy. We have present policy and we have proposed policy. Sir, how will you calculate the profitability? The first thing that you will take is the credit sales. What is the credit sale here, sir? 12 lakh and 14,50,000. Out of that credit sales, you will subtract the total cost of credit sale. What is the total cost here, sir? 10 lakh rupees and 12 lakh rupees. Okay. So after that, sir, the bad debts are also there. Do we have to take the bad debts for the profitability? No, sir. The bad debts, you just told us that the bad debts are not to be considered. I told you that bad debts are to be considered for profitability. The bad debts are not to be considered for opportunity cost. For profitability, yes, the bad debts will be there. Minus bad debts. The bad debts will be what, sir? 1% and 2% of the credit sales. 1/2%, right? So it is 12,000 and 29,000. Clear? So from here, if there is cash discount that is available, you will take the cash discount also, sir. Right? That is totally your choice. So from here, what we will get is, we will get the net profit, expected net profit. If the taxes are there, you will subtract the taxes also. Expected net profit. That will come to 1,88,000 and here 2,21,000. So one thing we have calculated, that is the profit. Now the second thing that we have to calculate is opportunity cost, right? Because I have to calculate the net benefit. I will first calculate here opportunity cost. right? Opportunity cost. For that, I'll prepare working note. From here, net profit minus opportunity cost, I will get the net benefit. So how to prepare the working note, sir? How to prepare the working note now is again a task. Working note number 1, that is calculation of opportunity cost. 1 second. Calculation of opportunity cost. How will you calculate it, sir? You have to calculate the opportunity cost for both the situations. That is, what is the present situation? In the present situation, what is the cost that is invested? Sir, 10 lakh rupees? Yes, sir. For what period it is invested? Sir, for 45 days divided by 360. What is the required rate of return? 10%. This will be your opportunity cost, that for 45 days you will be losing 10% on 10 lakh rupees. Right? So that will come to how much? That will come to 12,500 rupees. Clear? After that, the proposed policy. What is going to happen in the proposed policy, sir? What is the cost here? 12 lakh. What is the credit period under the proposed policy? 60 by 360 multiplied by 10%. Right? How much it will be? It will come to 20,000. So this is your opportunity cost here. 12,500 and 20,000. So what is the net benefit? Net benefit is 1,75,500 and 2,01,000. Sir, obviously your net benefit is more in the proposed policy. Now, if you try to analyze one thing here, sir, by having an extra opportunity cost of 7,500, you have increased your net benefit by 25,500. So why not go for the proposed policy? Increase the number of days. There is no harm in that. There is absolutely no harm in that, sir. You can increase, right? Because your net benefit is increasing by 25,500. Just go for the proposed policy. What is the issue in that? No issue. Enjoy. So this was the total approach, that how we can do it by total approach. Now let's do it by the incremental approach also. Now let's do it by incremental. The same question we can do it by incremental approach also. Same question we can do it by incremental approach also. How to do it by incremental approach? The same, present and the proposed policy. Now what we are going to write here, sir? We are going to write here incremental credit sales. Incremental credit sales means what is the additional sales? Incremental credit sales is what is the additional sales that you are generating under the proposed policy. That is the difference between these two. Difference between these two. What is the additional sales here, sir? So under the present policy, there will be no increment. Under the proposed policy, what is the additional credit sales that you are generating? 2,50,000. Now for this 2,50,000, what is the incremental cost that you have to incur? You will subtract here the incremental. You will subtract here the incremental cost of credit sales. The incremental cost of credit sales. What is the incremental cost, sir? 2 lakh rupees. Correct, sir. The incremental cost here is 2 lakh rupees. Now, what will be the next is incremental cost of bad debts. Incremental cost of bad debts. What is that cost, sir? The incremental is 29,000 minus 12,000. That is 17,000 rupees. Right? So from here, what you will get is you will get incremental expected profit. Incremental expected profit. We mark it as A. That comes to 33,000. Now, what is the second thing that you have to calculate? Second thing you have to calculate is the opportunity cost on incremental investment. Now, how to calculate the opportunity cost in this case. It is interesting, sir. A little bit of a twist here, right? What is that? Sir, while calculating the opportunity cost in the main solution itself, what you will do is you will first calculate what is the investment in receivables. What is the investment in receivables? Right? In the first case, under the present policy, what is the investment in receivables, sir? How much of the cost? 10 lakh. For how many days? 45 days. 45 by 360. What is the amount that is invested? That is 1,25,000. And here, what is the cost here, sir? 12 lakh multiplied by 60 divided by 360. Right? That comes to 2 lakh. So this is the investment in receivables. So if the total receivables are 10 lakh, so for 45 days, what is the amount of those receivables on which we will be losing the interest? Right? So 1,25,000 and 2 lakh. So here, from here, I will write incremental. What is the additional investment in receivables under the proposed policy? 1,25,000, 75,000. Now, this opportunity cost on incremental investment at the rate of 10%, that will come to 7,500. Now this is your opportunity cost. This is B. And if you want to find out the net benefit here, if you want to find out the net benefit, what will be the net benefit here, sir? Net benefit, that is A minus B. What is A? A is the incremental expected profit, that is 33,000. 33,000 minus 7,500. That is 22,500. The answer will be same under both the policies. Under the total approach also it was 25, what was the benefit? That is 25,500. Under the incremental approach also it is 25,500. So you can do it, the same question you can do it by both the methods, by any of the methods in the examination if nothing is mentioned. But if the question specifically says you have to solve it by a particular method, then please do not change that method. I have solved a particular question by both the methods. Right? So this is how. Now, what can be the variation, sir? The cost of credit sales might be given as variable cost and fixed cost. The fixed cost is not to be changed. Please be very careful. And when you are taking the this incremental approach, in that the fixed cost will not be there. The fixed cost will not change. Just all the ICI study module sums you will get to know there, right? All those who have already joined the FM ICI module series, they will get to know there, right? There also I have explained this thing. Okay, after that, if there is a cash discount, how to calculate the cash discount? One small thing is how to calculate the cash discount, right? So if it is given to you 2 by 10, if it is given to you 2 by 10 net 30, that means 2% discount, and 2% discount if you pay within 10 days, otherwise 30 days you have to pay the full amount. Now let's say your credit sale is 10 lakh rupees. Your credit sale is 10 lakh rupees, and I say 40% of customers avail cash discount, right? Now, if I ask you to calculate the amount of cash discount, how can you calculate it, sir? Firstly, what is the total sales? 10 lakh. Out of that, how many customers are availing? Only 40% customers are availing this. That means the customers worth 4 lakh rupees are availing the cash discount. And what is the cash discount? That is 2%. That means this 40% customers are paying you within 10 days, right? So that will come to 8,000 rupees. Now this cash discount will be taken here, sir. Here, after the bad debts, here you can take the cash discount also for calculation of the expected profitability. But for opportunity cost, no cash discount is to be considered. Very important, sir. Please remember it. Very, very, very important. Right? So this is all about the evaluation of the policies. Right? Evaluation of investment by total approach, by incremental approach, everything we have done, sir. Right? By both the approaches we have done. Now, the last topic here is the factoring. what is factoring, sir? Another very important topic. Now, first try to understand what is the concept of factoring, sir. First try to understand what is the concept of factoring. Once you have understood the concept, then the question is very simple. Question you can do it from the module. I'll just want you people to understand what is the concept of factoring, sir. Very interesting concept. And some questions are very good that you will get. Okay, now what happens, sir? There is Mr. A, right? Mr. A, and he has sold some goods to Mr. Y. Mr. A has sold goods worth rupees 1 crore on credit of 60 days. Now what happens, sir? Mr. A has to do it for his business, sir. Otherwise he will lose out on the business, right? Now he has sold goods 1 crore to Mr. Y on credit of 60 days. Now what will happen, sir? Mr. A will have sleepless nights. Why? This is not a small amount, sir. 1 crore rupees. This is such a huge amount. And every night when he is going to bed, he is having a nightmare that what if Mr. Y doesn't pay? Oh, Mr. Y is not paying my money. I'm losing out on 1 crore. 1 crore is a very huge amount for any business, right? So he is, every day he has to take some pills. Moreover, what he has to do is, sir, he has hired two people, one C and D, 10,000 rupees each. He is paying them salary, right? And the work is only for the collection. They have to focus only and only on the collection from Y, whether he will pay, he will pay. Every day they will call Mr. Y, 1 crore is pending. Mr. Y, when 1 crore is pending. So this is the work. He is incurring 20,000 here additionally, right? Additionally, he is incur the money on the pills that he is having. Now, in the meantime, he got to know about that there is another person, Mr. Z. There is a person named Mr. Z. One second. Now, what is the work of that Mr. Z, sir? Mr. Z says, Mr. Z approaches Mr. A. He says, Mr. A, don't worry, you do one thing. Mr. Z says, do one thing, sell your debtors to me. Sell your debtors to me, right? That means now Mr. Z will collect debtors. Mr. Z will collect debtors on behalf of Mr. A. Mr. Z will collect debtors. He is an expert into this field. He is into the business of collecting the debtors. But the thing here to notice that what will be the benefit to Mr. Z and what will be the benefit to Mr. A. Obviously, sir, both the people are doing business. The business, both of them are doing it for some benefit. So we need to find out what will be the benefit to Mr. A and what will be the benefit to Mr. Z in this whole scenario. Mr. Z says the benefit is that for this 1 crore rupees, I will give you the advance money. I will give you the advance of 90 lakhs right now. You do not have to wait for 60 days. I will give you 90 lakh rupees advance against this 1 crore rupees right now. Take it right now from me. Right? For 60 days, utilize this money. Take this money. Right? Mr. A is very happy. He says, I'm so glad. Now, why is he not advancing 1 crore rupees, sir? Obviously, he will keep some reserve money because when he has taken the debtors, he has taken the responsibility of the collection from the debtors. He is also taking up the responsibility of the bad debts. Now, bad debts responsibility will be of Mr. Z. Now, when he is taking up the responsibility, he is not going to advance 1 crore rupees. He will keep reserve money. Right? He will keep what? He will keep a reserve money of how much? Of 10 lakh rupees. Clear? 10 lakh rupees, he will keep the reserve money. Now, this 90,000, what is the benefit to Mr. Z? One thing is understandable, sir. This Mr. A will get 90 lakh rupees right now, which is a benefit for him. Right? But what is the benefit of Mr. Z in advancing 90,000 rupees, sir. Sir, Mr. Z is at a loss at any case. He is taking the bad debt risk. He will be collecting the debtors. He will be, going to the debtors. He will be going to the door to door asking the debtors for the money. Every headache is Mr. Z's headache. Then what is the benefit of advancing 90,000 rupees, sir? Why is he interested in advancing 90,000 rupees? Because Mr. Z will charge interest for 60 days. Till the time Mr. Z receives this money, right? He has given his money to Mr. A for using, right? So he will charge interest on this money. Clear? For 60 days. He says, I am giving you 90 lakhs. Mr. A will be ready for it. He says the interest cost will be less than the cost what he is paying to this person. This salary cost will be avoided. Administration cost will be avoided. Mr. A will not have to take the costly pills that he was taking, the sleeping pills. So he says interest cost is comparatively lesser than the cost of administration that he was currently incurring. This 20,000 rupees is the administration cost, right? Interest cost will be less than this 20,000 rupees and the cost of the pills, right? So it's ready for that. Another thing, Mr. Z, sir, will he be satisfied with the interest only? No, sir. Why? Because Mr. Z is providing the services. He says, I will charge commission also. I will charge commission also. Commission can be 1%, 2% depending upon the terms, right? And this is what is known as, factoring commission. So for Mr. A, some things will be beneficial, but some cost he will have to incur. The interest will be a cost, factoring commission will be a cost. These two will be the cost, but at the same time, he will save money, sir. He will save administration cost. He will save. What will be the benefit? Save administration cost. Secondly, he is receiving 90 lakh. He can deposit 90 lakh rupees and earn interest on that. So he will be saving on the interest part also. Otherwise, he would have received 1 crore after 60 days. Then he would have deposited in the bank. Then he would have started earning interest. Now, because he is getting 90 lakh upfront from the factor, this 90 lakh he can immediately deposit in the bank and start earning the interest on that. What is the problem in that? No, sir. He will save on the interest cost, right? He will save on the interest cost also, sir. So this is what is factoring. He says you have to evaluate whether the benefits are more than the cost or cost is more than the benefits. What are the annual benefits of the factoring, sir? What are the annual benefits of the factoring to the firm? Firm here means Mr. A. The firm here means the Mr. A, not Mr. Z. Mr. A. The credit administration cost avoided. What is credit administration cost? Sir, the salary of this 20,000 is the credit administration cost. Secondly, the bad debts will be avoided because the bad debt responsibility is now of Mr. Z, right? Thirdly, the interest saved due to reduction in average collection period. This is what I told you. Cost of annual credit sales into rate of interest into present minus the new period. Earlier, you were to receive in 60 days. Now, you are receiving the money in 10 days. Mr. Z says, I will pay you 90 lakh after 10 days. Right? So for 50 days, you will earn the interest on that money that you will receive from Mr. Z. That is a benefit to you, isn't it? For 50 days, you will earn the interest on that money. So that is also the benefit to whom? To Mr. A, sir. Right? It is not to Mr. Z, it is to Mr. A. But at the same time, there will be some cost that will be involved, that is factoring commission and the interest charged by the factor on advance. Net benefit you have to calculate. If the net benefit is positive, then you can go for the factoring treatment, or if the net benefit is negative, then you do not hire the factor, right? So this Mr. Z is known as what? This Mr. Z is known as factor, sir. Right? Now the factor can be an individual or factor can be a firm also. It is not necessary that it has to be an individual only. It can be an individual, it can be a firm also, right? So this factor part is done. So with this, all this was the discussion part of the debtors management. With this, we are done with the revision of debtors management. Approximately 1 hour we have spent on it. I hope everything is crystal clear. Now, the next step that you have to take is solve the module questions, right? And if you want to solve it from my side, then FMICI module series is already available on the mobile app. That is going to be extremely useful with these revision lectures. If you can do that, definitely you are on the path of scoring very good marks in the financial management. That is my guarantee to you. With this revision, the revisionary points, keep the notes in front of you and do the module questions. If you are doing only module questions also, now from that series, in that series also I have explained in a brilliant way. I have explained the topics in great in depth, right? Every question we have discussed in great in depth. So if you are doing that, it is going to immensely benefit during your examinations. That is definitely 101%. So we are done with the debtors management. The next topic that we'll take up is ratio analysis, right? Approximately 2 lectures for the ratio analysis, because there are a lot of ratios that we have to discuss, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.